frame all the way down to the lower time frames. So by having that alignment and by just seeing price change direction on the lower time frames, we anticipate a move in that higher time frame direction. That's about it. Okay, so couple things to go over. You can tell that GU is bullish on the day, right? And it's looking like it's going to go higher. So when we see that, we're thinking, okay, no reason to trade this at the downside, but hella reason to trade it to the upside. At that point, we scale down to the 4 hour to see if the 4 hour represents whatever we're seeing on the higher time frames, right? So what do we see here? Bullish structure. We see a nice retrace. We see a nice liquidity sweep. So we're thinking, awesome. If structure builds up on the lower time frames, it'll likely create an expansion on the higher time frames. With that being said, we scale down even further because we've established that the higher time frame structure allows for a move higher, and the lower time frame is looking to validate that as well. So what do we see on the hourly? We see a crazy wick here, right? But we ultimately see a bullish closure. We see another bullish candle that went over the body, which I'm thinking pretty much now it's not another break of structure, but it's a very good indication of bullish strength. So at this point, we know the 4 hour direction, the 1 hour direction, and the daily direction. The only thing that kind of sucks here is the fact that we are on Friday, so the week is about to close. So that big move that we're looking for is likely not going to happen. I should have took that into account. That's mistake number one. Most of the time, Friday trades are very low targets for me, and that's kind of what I did. But nevertheless, that wasn't enough to mitigate for it. So far, what have we said? Hourly, bullish, right? I mean, if you guys don't know what a bullish break of structure is and you're still around, just comment that and I'll just literally go over a gazillion and one examples. Here's one candle closure above the last wick of the last lower, of the last higher, lower, lower high, depending on if you're changing character or just breaking structure. So this is break of structure, break of structure. This is not a break of structure. You're probably thinking, oh, it closed below. No, didn't close below the previous lower low, which is this. So that's pretty much the only nuance there. So we say hourly bullish, boom, we get a retrace, we start to get an expansion, at which point we expect a continuation into all the way up here. So there's a lot to target as far as liquidity goes because we have people who have been shorting here, who got liquidated here, right? We have crap ton of people who are going to be shorting here. So we can take out them right here and then keep on going all the way up here. So with that being said, we scaled down even further on Friday. So we said 15 minute. Let's look into that. 15 minute flipped bullish. Boom. So now we just said hourly is bullish, 15 is bullish, 4 hours bullish, daily is bullish. So at this point, really there is not much reason for price to just drag itself on higher. The only thing that we have to avoid is the lower time frame minutia and ultimately not get caught up in these retraces. So how do we fade the retraces? Very simple. We let a retrace occur and we invalidate that retrace. So what's some things that we like to use to ultimately invalidate retraces or validate expansions? We pretty much like to enter from a discount. There's not much point in entering from a premium. Now, what did I do that day? Something else. I entered from a premium. Most of the time, I like to fade the premium entry and I like to go for the discount entry when it comes to longs. When it comes to shorts, it's vice versa. You want to enter from a premium so that you're able to short it down to the discount. Make sense? So at this point, I told myself 15-minute fair value gap right here, another 15-minute fair value gap over here, and finally this 15-minute fair value gap. Now, these were the two good areas that I marked out. This one, normally I would tend to disregard, but I kind of really liked the move that was developing here because price was pricing itself very efficiently. So I kind of just, instead of having this here, I had it here because this was the last expansionary move. And even then I couldn't justify it. So I really kind of squeezed this trade in truth. So it explains the loss. We still would have lost had we entered here, but I took two trades that day, at which point I decided to stop because I don't trade more than maybe twice a week max. And that was 3 times. We're still up on the week, but nevertheless, Friday was definitely a way for me to say, yes, I kept my risk management, but I took poor execution. Could have just took one trade here, lost, called it a day. But instead I lost two. So I'll go over the executions at this point. They're pretty quick. We had a 5-minute retrace. We never flipped structure. So I saw the first break of structure into this fair value gap. I literally entered. Boom. Price went, stopped me out. It reacted off of this fair value gap. What happened again? I saw this liquidity sweep, break of structure, reaction. I entered. Boom. Same thing again. Why? We were entering from a premium. So what is the lesson? Enter from a discount to see the big move. Pretty much that's it. I'll see you guys in the next one. Join the Discord, please. It helps.